Well, hello from my office here at West Virginia University. Today we're going to talk about Apple. We're going to talk about accounting for stock splits, accounting for treasury stock, and in the end we'll look at one or two balance sheet ratios. So, Apple, where do I get my information from? www.sec.gov, top right, company filings. Enter AAPL, Apple's ticker symbol, and then go through and click on the Form 10K, which is their annual report. So, for the year ended September 2020, we have total revenue, net income. And when I look at these numbers, down a bit, up a bit, down a bit, up a bit, but not even to that level, it doesn't make that great a picture on a graph. Sales, net income, this is definitely not the graph of high growth. When I look at their stock price, on the other hand, I can see beginning of 2018, $42 a share, close of business on Friday, $118 a share. The share price has tripled. What could the reason be? Is it the dividend? Well, 20.5 cents per quarter, 82 cents per year, 82 cents divided by that gives us a dividend yield of 0.7%. Nothing great, not great enough to cause the share price to do this. There must be some other factors at play, and let's see whether we can figure out what they might be. But we're going to start with the share split. So, they announce that at the close of business of August 28th, each common share will be split into 4 shares of common stock. This is known as a 4-for-1 split. You had 100, now you have 400. In their balance sheet, they note that all share and per share information has been retroactively adjusted to reflect the stock split. So they pretend that the stock split occurred right at the beginning of the period covered by the financial statements. They say this 3 times. They repeat themselves over and over again, which is what I've just done, which could explain why annual financial statements are so long. So once again, this is the real number of shares outstanding as of September 26, 2020. They have gone back and adjusted these numbers as if the split occurred at the beginning of this period, October 1st, 2017. So, this is what they've just reported. When I go back to the fiscal year 2019 and I look at those actual numbers in their actual 10K, you can see diluted 4.6 billion, diluted 5 billion. They've gone back and adjusted this to 18.6 and 20. These numbers have been retroactively adjusted. That also means that the earnings per share numbers, these two over here, have been retroactively adjusted as if the split occurred on October 1st, 2017. In their financial statements, one of the notes is selected quarterly financial information. They give revenues, they give diluted earnings per shares, and all of these, except the first one, all of these have been retroactively adjusted by dividing by 4 as if the split occurred at the beginning of the period over here or the beginning of the 2018 fiscal year. Watch this though. Their first quarter is the highest. And normally, for companies, their fiscal year ends just after their busiest quarter. And for Apple, it's not ending after the busiest quarter. It's ending 30th of September. And I think in Apple's past, the busiest quarter was the back-to-school quarter, August, which is why their fiscal year ended September 30th. And I think that this is a little bit of a blooper, and we'll talk about it right at the end of the video. Just for a note, they talk about their fiscal year. They say it is the 52 or 53-week period that ends on the last Saturday of September. So, this is what they reported for the quarter ended June 2020. Watch these numbers. 258, 4.3. This is what they reported for this quarter. 499, 4.4. If we go back, we can see that these numbers have been adjusted. We go back here. This divided by 4 is $1.25. This divided by 4 is 65 cents. And there we see it. $1.25, 65 cents. Retroactively adjusted. Second point. They have a buyback program. Let's see what a buyback does. The company was authorized to purchase up to $225 billion of the company's common stock under a share repurchase program. So let's have a look. Net income 1,000, shares outstanding 500, earnings per share. Net income 1,000, shares outstanding less, I bought back 100, earnings per share nicely up. This is a little mathematical trick. Shares outstanding down by 20%, earnings per share up by 25%. The increase in earnings per share is more than the decrease in the number of shares outstanding. So you can get a wonderful bump to your earnings per share by simply decreasing the float. Now, they have bought back. This is their annual financial statements, and this is their note, and we're talking about the number of shares. 2018, bought back 1.6 billion, so you can see a drop here. Bought back 1.3 billion, so outstanding drops. Bought back close to $1 billion, number of shares outstanding drops. And they have a way to go, approximate dollar value of shares that may yet be purchased, $56 billion. This is in dollars, these are actual share numbers. So, they bought it back. If we go to the statement of cash flows, financing activities, this is a huge outflow. Repurchases of common stock. Here we go. And this is in millions. So, 72,358 million. 66,897 million. Again, 72,000 and a fraction million. The cash flowed out. Usually the way that we account for this is we will go debit treasury stock, credit cash. Let me go back. This is a big credit to cash. And then it is a debit to treasury stock. However, when I go to Apple's balance sheet, shareholders' equity, I don't see a treasury stock account. It's gone. I don't see a treasury stock account. It's gone. They don't have a treasury stock account on their balance sheet, not here where it should be, nor upstairs in assets where it shouldn't be. It isn't even where it shouldn't be. If we go to IBM, stockholders' equity, we can see in the stockholders' equity, treasury stock at cost, dollars, number of shares. Procter & Gamble, shareholders' equity, treasury stock at cost, number of shares, dollars. For Apple, it's nowhere there. What's happened is Apple has effectively retired the shares. And retired means take it out of circulation, it is no more. Now they talk about what on earth do you debit? With any remaining amount being charged to retained earnings, they do not have this additional paid-in capital associated with the original sale. They have to debit retained earnings, and indeed that is what they've done. If we go look at the statement of shareholders' equity, common stock repurchased, a huge debit to retained earnings in each of these 3 years. And it is rather amazing that this company is so profitable that they can take these huge debits to retained earnings plus the huge debits $14 billion, $13 billion for the dividend and still show a positive retained earnings at the end of the day. So what they did was they purchased it. They might have put it into treasury stock for a day or two, but then right away retire it and write it off against retained earnings. And just as a reminder again, they have $56 billion to go, and this is what might be propping up the share price. The fact that the number of shares keeps decreasing, that gives earnings per share a boost in and of itself, and they have a way to go. Final thing, I look at the balance sheet and I see they have mountains of cash under assets, cash, marketable securities, current assets, long-term assets, marketable securities. Add it all up, $192 billion cash and marketable securities. Then I go to the liabilities and I see debt. 1, 2, 3, there they are. 1, 2, 3, $112 billion. Net cash minus debt, $79 billion. And my question is, why do they have this debt? Normally, when you have debt, you pay more interest than what you get when you invest in marketable securities. And I'm just wondering why Apple would do that. They surely don't need the cash. They're a highly profitable company. There must be a good reason for it. I'm just saying, I don't know what the reason is. And once again, I'm coming back to this little blooper. In their Form 8K, they said that, change in fiscal year. I believe that this is a little blooper. What Apple is going to do is they are going to change their fiscal year to a December year end. If they do that, one of two things can happen. They can have a short fiscal year of 3 months only, October, November, December, that's it. It'll be a fiscal period. Or they can have a 15-month fiscal period from October 1st all the way through to December 31st of the following calendar year. I think it's coming, and I think this little blooper here, this typo, is an indication of what might be coming in the future. So, it's coming because their first quarter, which is the quarter that includes December, their first quarter is their biggest quarter, and in fact they say so in their financial statements as well. They don't admit that the change is coming though. So, to conclude, I have a website. There it is. This is my book. Lots of free things and extra things. No need to register. I have a Benford's Law page. I have a YouTube page. And I have a few other pages. Please go, visit, enjoy. It's all there for you. If you like my video, click like, and I'll see you next time. For now, bye-bye.